A lot of my viewers, subscribers, and Leveraged ETF fans have read this blog from Hedgefundie. After reading that and watching my videos on Leveraged ETFs, an obvious question I often get asked is, what is my opinion on Hedgefundie's strategy? Let's break this down. Hey guys, welcome to Think Finance. My name is Raj, and this channel is all about personal finance, investment ideas, and everything money. If you're following Think Finance, you know I'm a big fan of leverage ETFs, and it is a big part of my long-term portfolio. Before you start hitting me with questions around decay and how leverage ETFs is a no-no for long-term investing, watch this video out and other videos I have in my leverage ETF playlist where I break down my overall strategy. This video assumes that you understand leverage ETFs, and just like me, you are a believer in these as an investment tool for the long term. Alright, so in this video, I want to dive deeper into Hedgefundie's strategy, compare this to my strategy, and talk about a few money-making scenarios. All of the analysis in this video is based on actual data. I'm not making up any numbers here. Let's start by summarizing the Hedgefundie strategy. I don't know the real name of Hedgefundie, so I'm just gonna call this person Fundie, and she is a pretty girl. Fundie started her portfolio in February 2019 in M1 Finance with an initial investment of $100,000. This is based on pictures posted on the blog. She expects her portfolio will hit $10 million in the next 25 to 30 years. The strategy is pretty simple. Invest in unrelated assets, stocks and bonds to attain diversification. By the way, this is super smart. Check this video out to understand why this makes total sense. Then allocate based on volatility. So if one goes down, the other can somewhat compensate for the losses by going up. Finally, you throw in leverage, which should in theory amplify your gains and hopefully beat the S&P 500. To manage this strategy, she is using Leveraged ETFs UPRO that tracks the S&P 500 and TMF that represents long-term treasury bonds. The idea is to have a hands-off approach to investing and let the portfolio grow in value over time. The question is, does this work? In the first 8 months, the portfolio took off and was up 43%. So it works, right? See, 2019 was a banner year for most investors, with S&P returning almost 30% and UPRO gaining 103%. Fundie posted another performance update, this time in March 2020. This is when the pandemic wrecked the market. The portfolio gave up all its gain and went negative. So it does not work, right? Actually, this strategy works. If Fundie stayed the course, portfolio value as of last month would have been at 166K. A return of 66%. Before you stop watching this video and implement this strategy for yourself, it is key to understand why this works and how can you make it better. It's important to understand the relationship between economy and long-term treasuries. When investors expect economic uncertainty, demand for long-term treasuries go up. And since the value goes up, yields go down. Similarly, when the investors expect economy to grow in the short term, demand for long-term bonds go down, which means yields go up. This is actually what's happening right now with all the yield noise that you're hearing on CNBC. Here's the bottom line. Investors hate uncertainty. If they see it coming, they will park the money in long-term bonds. The idea is that their money will be safe with the government as opposed to investing in other short-term investments. For example, When pandemic hit, investors anticipated short-term uncertainty. Demand for long-term bonds went up and stocks dropped. More in this video. By investing in UPRO and TMF, Fundie somewhat reduced the overall risk. If she was 100% in UPRO, her portfolio would have been down big at 65K. Remember, she started at 100K. While she lost all her gains, by having money partly invested in TMF, her portfolio was flat at around 100K as opposed to 65K. Why? Again, the relationship between economy and long-term bonds. While the market was dropping, investors rushed into bonds, which meant that TMF went up and kept Fundie alive. The whole purpose of having TMF in portfolio is to manage risk and somewhat limit the drawdown. You don't want to be 100% in UPRO, since if market dropped big, it will take a lot more to go positive. Now you can argue that UPRO has done fine since inception, but then we also were in one of the longest bull market in history, and post-pandemic, we entered a new bull run. In summary, it works, but I'm not into it. I have my own strategy to manage leverage ETFs to generate high returns while still managing risks. Of course, it's more aggressive compared to the Fundie strategy. Here is how I use leverage ETF. The strategy is based on three things: allocation target, rebalance thresholds, and buy thresholds. I allocate 30% of my portfolio in leveraged ETFs. If markets do well and leveraged ETFs hit 50% allocation, I will rebalance from leveraged ETFs into non-leveraged positions. My non-leveraged positions are kind of playing the role of TMF. If market goes south, I will buy more when Nasdaq drops 10%, 20%, and 30%. This helps me bring down my dollar cost average. This is how I manage risk, and it works. Take a look at my leverage ETF videos where I go into much more detail. At this point, you're thinking, why deal with allocation target, rebalancing, buying the dip, and all that nonsense when Fundie strategy works and is hands-off? I know it's a long video, but hear me out. Let's compare a few scenarios, and I'll try and keep this as objective and realistic as possible. These scenarios are not exactly how I would do in my portfolio due to two limitations, but they get really close. Close enough to prove my points. Few things to note. For all scenarios, I'm taking data from 2011 to 2021. 2021 is when most ETFs were created, so that's as far as we can go. I'm going to standardize initial investment amount to $100,000. Rebalancing will be semi-annually, and buying the dip will be represented by throwing $5,000 every quarter, which is reasonable. Scenario 1, the Fundie way. If Fundie had started a portfolio in 2011, as of 2021, it would be sitting at around 900K. Pretty impressive. Scenario 2, the Think Finance way. This is how I invest, and this scenario tries to mimic my strategy as much as possible. I'm using TQQQ, SOXL, and UPRO as leverage ETFs, which I invest in, and these mostly cover the broader market. QQQ represents the non-leveraged positions in my portfolio. I'm using QQQ since my non-leveraged stocks are mostly tilted towards growth and also includes 20% in ARK ETFs. The scenario assumes rebalancing semi-annually and buying any dips, $5,000 every quarter. If I started this in 2011, today I would be sitting on a portfolio valued at $3 million. This means I win and Fundie sucks, right? No. See, I'm throwing in new money every year, which helps the overall growth in the account. Let's level the playing field a bit. Scenario 3, Fundie plus the Think Finance way, version 1. Let's throw in rebalancing and buying the dip variable and keeping everything else the same in the Fundie scenario. If Fundie did that, the account value today would be at $2 million. Not bad at all. One can argue, hey, I don't have new money to buy the dips. Fair call out. Let's look at scenario 4. Fundie plus the Think Finance way, version 2. Let's throw in rebalancing only and not worry about adding any new money. In that case, the account value today would be at $1.2 million. May not be worth the headache, but still $300K more than the original Fundie strategy. Now you can slice and dice this in a number of different ways. The point is pretty clear. Buying dips and rebalancing can further amplify growth in your portfolio. I'll leave you with 2 more scenarios that actually surprised me. In scenario 5, if Fundie did nothing else but just replaced UPRO with TQQQ, the account value would have been at $3.3 million. If you take this a step further and throw in the Think Finance twist and rebalance and buy the dips, the value would have exploded to $4.2 million. That is something. By the way, I'm using Portfolio Visualizer just in case you want to mess with the numbers a bit. I'll be honest, the last 2 scenarios really made me think. Looks like the Fundie way with the Think Finance twist is something worth exploring further. What do you guys think? Does this make sense? Let me know in the comments if you have your own scenarios. Thanks for watching. Hope this was fun. Until next time, peace.